Good morning, and thank you for joining our market update. My name is Taylor Thomas. I'm the Director of Financial Planning here with NCM Capital Management. As you probably know, the rate of inflation will most likely continue to be key to the markets in the short term. But before we discuss inflation in greater detail, another problem has surfaced since our last update. Once again, we have the case of a large investor, this time UK pension plans, who use leverage with their investments that were structured to protect them from lower yields. But when the interest rate environment changed and moved against them, they basically needed to be bailed out by the UK central bank. Now, you could think of leverage almost like a magnifying glass, in that it will intensify the outcome of an investment. For UK pensions, unfortunately, it was losses that were magnified. And as good old Warren Buffett says, when the tide goes out, we see who is swimming naked. Now, this is a funny statement, but is truth when market volatility hits. Relating back to inflation, there's a great debate on how to solve the inflation problem. Some criticize the Fed for both overstimulating the economy and starting to raise rates too late. Others claim the Fed may have already done too much. Still, another school of thought is that interest rate increases in and of themselves are not the appropriate tool because the real problem of inflation is supply in areas like food, energy, and housing, for example. So are rate increases really going to help us get the fertilizer we need? Or will an end to the Ukraine war do that? We need more houses. Will rate increases solve that? Actually, increasing rates will have the opposite effect. They hurt the housing market. What about energy? Energy is still an attractive investment in our view, as energy supply could likely remain a serious long-term problem. However, interest rates generally do not have a direct effect on energy prices. Of course, the irony in this inflation debate, and it might be hard to see in the moment given the period of market volatility we're going through, is that if inflation really does become a long-term structural issue, the assets that have always been an effective hedge to rising prices are the assets that some people are selling or don't want to buy right now. For example, stocks and real estate. In order to be proactive, during the current period of high inflation, we've begun to allocate capital to businesses that are expected to benefit via a rise in revenues from the elevated price of commodities and other real assets. An example of this would be a company that owns mineral rights and is paid royalty income as commodities like oil and natural gas are extracted. Royalty revenues should increase without any meaningful increase to expenses for the company, netting a larger profit for the shareholder. Additionally, we remain cognizant of the risks and will position portfolios accordingly. Excess cash, alternative and hedged investments, dividend stocks with option overlay strategies are our preferred ways of addressing the current market risks. As always, to our clients, thank you for your continued confidence as we work through these challenging times. And to everyone who is listening, please don't hesitate to reach out with any questions. We look forward to hearing from you. Thank you and have a great week.